All right, this is Ubaid on behalf of V Electronics, and in this video, we'll be talking about the aggregate demand curve. All right, now when it comes to your aggregate demand, okay, this is what the aggregate demand curve looks like over here. Okay, this would be your aggregate demand, and this has to do with price level, okay, and GDP or real GDP. All right, and the way this works is there's a price level in the basket of goods, which has to do with total products and services produced within an economy. As that price level goes down, the real GDP goes up. Okay, because the aggregate demand goes up. All right. So, say for example, you have consumer spending. Okay, we've talked about how the Bureau of Labor Statistics collects information, data from households relevant to consumer spending patterns. Okay, when they collect data, when they collect information along with the prices from the retail stores, suppose these price levels are falling at some point. Okay, suppose the price levels are going down. Right now, what's going to happen if the price of an item goes down? Obviously, the demand will go up. All right, and likewise, if the price levels, okay, if the price of all goods and services within an economy goes down, the quantity consumed or quantity demanded will go up, which has to do with the basket of goods, and which has to do with the price level for the basket of goods, which we use to figure out the inflation rate. Now, as the price level goes down, as the prices fall, for example, demand goes up and the real GDP goes up because consumer spending goes up. So you have consumer spending. Okay, so consumer spending goes up. All right, now because consumer spending goes up again, the GDP goes up. Now, relevant to your aggregate demand curve, because obviously aggregate demand is made up of four components, just like your real GDP. Okay, your aggregate demand curve. This is made up of four components. All right, and this has to do with personal consumption, okay, which is consumer spending, for example, within the economy, what the residents of the country spend. Okay, if they increase their spending, if their spendings go up, okay, if the amount of money they spend goes up, then obviously the economy will expand, okay, and the aggregate demand will go up. Okay, it also has to do with, okay, government investments or government infrastructure. So if the government makes an investment on things like bridges, highways, okay, government infrastructure, okay, then obviously the aggregate demand will go up. Okay, the more the highways, the more the consumption, the more we drive on those highways, as a result of which your AD goes up. So this has to do with government investment or government spending. All right. And the third component of the GDP or aggregate demand has to do with a business investment. So we're talking about capital or capital expenditure. So this would be like investment in equipment, machinery, building, okay, so on and so forth. So if you have a machine in a factory, for example, that's a capital investment. Okay, so this is machinery. And the last but not least component, okay, the last component of your GDP, okay, has to do with net exports. Okay, so the last component has to do with net exports. So net exports is basically imports take away exports. Now, in an ideal economy, your net exports will be positive, which basically means that you're exporting more than your import, okay, than what you import. Okay, so import versus export. And this also has to do with trade balance. Okay, okay, some people prefer equal trade balance where import equals export. But in terms of business, in an ideal economy, okay, your net export should be positive, which basically adds to your GDP, as a result of which your export should be more than import. All right, now, because of these four components of aggregate demand, what's going to end up happening is, okay, you will have a theory number one has to do with wealth effect. Okay, and what is wealth effect, you may ask? So, wealth effect has to do with the concept of the theory where, okay, as the price level of basket of goods goes up, okay, the consumer spending goes down. Okay, so wealth effect as price levels, okay, so as price levels go up, your consumer spending goes down. And because your consumer spending goes down, okay, there is less aggregate demand. So the aggregate demand is reduced. Okay, there's less money being circulated in the economy. Okay, the economy shrinks. Okay, the inflation rates may go up. Okay, right? Because obviously, as the price level, and we've learned that price levels of the basket of goods, it will figure out or will lead to high inflation rates. So this is high inflation rates. So as the inflation rates go up, okay, what's going to end up happening is consumer spending will go down because the purchasing power of the currency goes down, right? So what consumers can buy, the purchasing power within an economy, so purchasing power within an economy goes down. And because this purchasing power goes down, what's going to end up happening is, okay, the economy will shrink. Okay, so this economy will shrink. And because this economy shrinks, your real GDP will shrink. So our GDP will shrink. Okay, so our GDP goes down. All right, so this has to do with wealth effect. The second theory, based on aggregate demand curve or aggregate demand in general, has to do with your interest rate effect. And the interest rate effect basically says that, okay, as the interest rates go up, and this may have to do with your monetary policies, where the central or reserve bank may bump the interest rates up. As the interest rates go up, okay, to control inflation, okay, because obviously high interest rates will bring down your inflation rate, okay, and money will not be devalued, okay, it may be overvalued instead, okay. So as interest rates go up, consumer spending goes down, okay, and investment goes up. So borrowing goes down, but investment goes up. Because think about it, who's going to borrow at a higher interest rate? Okay, everybody wants to borrow a loan at a low interest rate. So consumer spending goes down because obviously, if you can't borrow money, you're not going to spend it, right? You're going to save money instead, okay, for a better day. So consumer spending goes down, and as consumer spending goes down, your real GDP will go down because consumer spending is part of the four components of your aggregate demand or real GDP. Okay, this is your personal consumption. So if personal consumption goes down, okay, your aggregate demand or real GDP will go down as well. Because at the end of the day, if you want to figure out your real GDP or aggregate demand, you have to add all these four components. Okay. All these four components make up your real GDP. All right. So as consumer spending goes down, your real GDP will go down. So in both cases, whether you have aggregate demand or your interest rate effect, okay, your real GDP will take a hit. Okay, in both cases, the real GDP will go down. All right. So that's it for this video. On behalf of B Electronics, this is Obey. Have yourself a great day.